Okay, let's get into this. We have this idea, I think, that to get good at something, an exam, a sport, whatever, you study the best. You find that perfect example and you try to copy it.
It's the standard way, right? Find what works and replicate it. It feels safe.
It does. But there's this other school of thought that says you learn way more by studying a complete disaster. You don't just want to see what went right. You have to dig into what went horribly wrong.
Well, in things like surgery or aviation, they call it a postmortem. You study the crash so it never happens again. And that's pretty much exactly what we're doing today with the ACCA financial management exam.
Specifically, we've got the examiner's report from the September and December 2025 sitting. And reading this, it honestly feels a bit like a detective story. We've got all the clues here telling us exactly where people slipped up.
It's a goldmine. The examiner is so blunt about it, which is fantastic. They point to the exact technical traps, the little misunderstandings about derivatives, even simple reading errors that cost people marks. So our job today is to decode all of that so you don't fall into the same traps.
So we've got a clear plan. We'll start with those little objective test questions in Section A, what I'm calling the devil in the details. Then we'll hit working capital strategies, some valuation weirdness in Section B.
And then the big ones, the Section C questions on receivables and, everyone's favorite, WACC calculations.
Right. But it all seems to boil down to one thing, really. Precision.
It really does. The difference between a pass and a fail in a lot of these cases was a single word. Or, a missing fraction.
Okay, precision it is. Let's jump into Section A. The examiner flagged this first one about a company called Apollo Co. This seemed to catch a lot of people out.
It really did. It's about forward rate agreements, or FRAs. So Apollo needs a $10 million loan for 9 months. But they don't need it right away. They need it in 3 months' time.
So they're worried rates will go up between now and then.
Exactly. So they hedge. They buy what's called a 312 FRA at a rate of 4.6%.
Just to quickly clarify, 312 means the agreement covers the period from month 3 to month 12, right?
Correct. It covers that 9-month loan period perfectly. So fast forward 3 months, and the actual market rate turns out to be 4.5%.
Okay, so they locked in at 4.6, the market is 4.5. Now here's the trap. My first instinct would be, hey, the actual rate is lower. That's good for me. I should be getting some money here.
And that is the number one mistake. You have to think about what the hedge is designed to do. Its goal is to give you an effective interest cost of 4.6% no matter what.
Right.
So if the market lets you borrow at 4.5, you're actually borrowing too cheap compared to your agreement. You've won on the actual loan, which means you have to lose on the hedge to balance it all out.
Ah, I see. So because I'm saving 0.1% on my real loan, I have to pay that 0.1% to the bank on the FRA contract to bring my total cost back up to 4.6%.
Precisely. So step one, it's a payment, not a receipt. A lot of people got that wrong.
Okay, so it's a payment. But that wasn't the only trap, was it? The actual calculation was tricky too.
This one is even more painful. So the difference is 0.1%. You take $10 million, multiply by 0.1%, and you get $10,000.
And that looks like a perfectly reasonable answer to choose.
It's the classic distractor answer. It's plausible, but it's wrong. You have to remember, interest rates are quoted per year, annually. This was a 9-month loan.
Oh, of course you have to time apportion it.
You absolutely have to. So you take that $10,000 and you have to multiply it by 9 over 12.
Which gives you $7,500.
Yes. The correct answer was a $7,500 payment. If you rushed and forgot that 912, you walked straight into the trap.
That is just brutal. Okay, let's move to the second example from Section A. This was about economics. The question was, what happens in a country with low inflation?
Yeah, this is about connecting the dots. The examiner's comment here was that candidates showed limited understanding, which is a very polite way of saying most people bombed this question.
Ouch. Okay, so let's walk through it. Low inflation. What does that mean for an economy?
Well, first, think about people at home. If prices aren't rising quickly, your money goes further. So domestic demand for goods and services, that's likely to go up.
Makes sense. Stuff feels cheaper, so you buy more.
Second, think about the cost of capital, the WACC. Low inflation almost always means lower interest rates, so the cost of debt falls. It also generally means the economy is more stable, so investors don't demand such a high return, so your cost of equity can fall too. All in all, WACC goes down.
Okay, those two feel pretty logical. But the third one, the currency, I think this is where people get tangled up. The gut feeling is low inflation means a slow economy, so the currency should get weaker, right?
That's the common mistake. But you have to think about it from a global trade perspective. If your country's prices aren't rising, but another country's are, your exports suddenly look really, really cheap. They're competitive.
Right, so everyone wants to buy your stuff.
And to buy your stuff, they first have to buy your currency. That increase in demand for your currency pushes its value up. So low inflation actually leads to an appreciating currency.
It's a chain reaction then. Low inflation, more competitive exports, more demand for your currency, stronger currency.
Exactly. And if you miss any link in that chain, you get it wrong.
Let's shift to the third example from Section A. A tale of two companies, Cain and Abel, and their working capital strategies.
A biblical showdown over funding policy. Love it.
So the question is, are they aggressive, matching, or conservative? Before we look at the numbers, can we just nail down those definitions? What makes a policy conservative?
It's all about how you fund your assets. Every company has a baseline level of assets they always need. That's permanent working capital. Then they have seasonal peaks. That's fluctuating. A conservative policy is super safe. You use long-term finance like bonds to cover all of your permanent assets and some of the fluctuating ones too.
But isn't long-term funding more expensive?
Usually, yes. That's the trade-off. You pay a bit more in interest for the security of knowing that cash is locked in. You sleep well at night.
Okay, so that's conservative. Aggressive is just the opposite.
Total opposite. It's risky. You use cheap, short-term finance, like an overdraft, to fund not just your seasonal peaks, but also some of your permanent core assets. It saves you money, but if the bank calls in that overdraft, you're in big trouble.
And matching is the middle ground.
The Goldilocks option. Long-term funds for long-term assets. Short-term funds for short-term assets. Perfectly matched.
Okay, with that in mind, let's look at Cain. The data says their minimum or permanent working capital is $15 million. But they have $17 million in long-term debt.
And there's your answer right there. They only need $15 million of stable funding for their base, but they have $17 million. That extra $2 million of long-term funding is being used to cover fluctuating needs. They are overfunded with stable cash. That is, by definition, conservative.
And Abel.
Abel's permanent assets were $18 million. Their long-term debt was exactly $18 million.
A perfect match.
A perfect match. So they are using a matching policy. It's really just about comparing those two numbers. Don't overthink it.
Let's move into Section B then. The valuation questions. First up was a company called Co. and a dividend growth model question.
Yes, and this one was all about understanding two little terms, cum-div and ex-div.
The trick was in the wording. It said the company was expected to pay a dividend of 60 cents in the near future. That phrase, in the near future, is doing a lot of work there.
It's doing all the work. It tells you that if you buy the share today, you are also buying the right to receive that imminent dividend. The share is trading cum-div, or with dividend. I like to think of it like buying a wallet with $50 cash inside. The price should reflect the value of the wallet plus the $50.
That's a great analogy. So the standard dividend growth model, that just gives you the value of all the future dividends, right? The empty wallet.
Exactly. It gives you the ex-div price. So when students did the calculation, they got a value of $6.80.
And a lot of them probably stopped right there.
They did. But that's the ex-div price. Since the question implies the share is trading cum-div, you have to add that 60-cent dividend that's about to be paid back on top.
So $6.80 plus 60 cents gives you $7.40.
And that was the correct answer. It's a conceptual trap, not a math one. You just have to ask, what am I actually buying today?
Okay, another Section B trap was with Co. and their convertible loan notes. Investors had choice. Get their money back with a 15% premium or convert their notes into 20 shares. The question was about the indifference point.
Yeah, this one stumped people because they went looking for some really complicated formula, but the logic is incredibly simple. The word indifferent just means both options have to be worth the exact same amount.
Okay, so let's break it down. Option A is cash. The note is $100. A 15% premium means I get $115 cash. Simple.
Right. And option B is you get 20 shares. So for you to be indifferent, those 20 shares have to be worth.
It's exactly $115. So you just divide 115 by 20.
That's it. It's just a division problem. $115 divided by 20 is $5.75. If the share price is $5.75, the two choices are identical. People get lost in the jargon, but it's just about making two piles of money equal.
It's amazing how simple it is when you put it like that. One last thing from Section B, the examiner mentioned the term noise trading.
Yes, this is about market efficiency theory.
And the key point was that noise trading is, well, it's irrational. It's trading based on rumors or just following the crowd, not based on any real data.
Exactly. You need to know how it's different from, say, fundamental analysis, which is what we've been doing, looking at dividends and growth, or technical analysis, which is looking for patterns in charts. Noise trading isn't based on information at all. It's just vibes.
We should come back to that idea later.
Yeah.
But for now, let's get into the heavy stuff. Section C, the big written questions.
And this is where just pure exam technique and careful reading really come into play.
So let's look at Constant Co. This was a receivables management question. They had to choose between offering a discount for early payment or hiring a factor.
And there was a reading error here that in the real world would have cost a company hundreds of thousands of dollars.
Tell me about it. The scenario said the factor's offer would reduce bad debts to 0.5%.
That one little word. 2. The old bad debt level was 2%, so reducing it to 0.5% is a reduction of 1.5%.
But I'm guessing a lot of candidates read it as reduced by 0.5%.
So many did. And think about what that does to your numbers. Credit sales were $45 million. The correct interpretation, a 1.5% saving, is a benefit of $675,000, a massive saving.
But if you misread it as a 0.5% reduction, you'd only calculate a benefit of $225,000.
And your entire conclusion about whether to accept the factor's offer is now probably wrong. It all hinged on reading one preposition correctly.
Wow, and the examiner also noted that some people miss the finance cost saving entirely.
Yeah, if a factor helps you collect your debts faster, your receivables balance goes down. That's cash that's no longer tied up in unpaid invoices. It means you can reduce your bank overdraft, which saves you interest. That interest saving is a real, tangible benefit of the factor service.
So, lesson 1 from Section C. Read every single word. Now, there was also a theory part to this question on cash management models. Baumol versus Miller-Orr.
Right. The Baumol model is basically the EOQ inventory model, but for cash. It assumes you use cash at a nice, steady, predictable rate. It's very simple.
But cash flow in the real world is almost never that predictable.
Exactly. And that's why we have the Miller-Orr model. It's designed for messy, unpredictable cash flows. It sets an upper and a lower cash limit. Your cash balance just bounces around between them. If it hits the top, you buy investments. If it hits the bottom, you sell investments. It's way more realistic.
So the key is just knowing which is for which situation. Baumol for predictable, Miller-Orr for unpredictable.
That's the main distinction they're looking for.
Okay, let's tackle the final beast. The mean co question on WACC and capital structure.
This was just a minefield. So many potential little errors. Let's start with the cost of equity. The share price was given as $7.26 ex-dividend. The nominal value was 50 cents.
Rule number 1 of WACC, right?
Mm-hmm.
Never, ever use the nominal value for these calculations. It's an accounting figure. It's irrelevant. Use the market price, the $7.26.
Correct. But then came the dividend. The current dividend, D0, was 49 cents, and growth was 5%.
Ah, and the formula for cost of equity needs D1, the dividend in 1 year's time.
Yes. And so many students just plug the 49 cents straight in. You have to grow it by 5% first.
Yeah.
You have to calculate D1. If you use D0, your cost of equity is wrong, and the rest of your WACC calculation is just, it's worthless.
Okay, so use D1, not D0. What about the debt? It was redeemable debt.
Redeemable debt means you have to do an IRR calculation. You can't just take the coupon rate.
Why not? Why is it more complicated?
Because of tax. The interest you pay each year is tax deductible, which makes it cheaper. But the final repayment of the principal amount when the bond matures, that is not tax deductible. So you have a series of tax deductible cash flows followed by one big non-deductible one.
So you can't use one single after-tax rate.
You can't. The only way to find the true overall cost is to map out all the actual cash flows and calculate the internal rate of return, the IRR.
And when it came to weighting everything together, let me guess, market values.
Always market values. Book values are history. WACC is about the cost of raising money today, so you have to use today's market values for equity and debt to get the weightings right.
And finally, there was the discussion part on capital structure theory.
Yes, the so what does it all mean part. How does adding debt change your WACC?
And you've got the two big competing ideas, the traditional view and Modigliani and Miller.
Right. The traditional view is the common sense one. It says there's a U-shaped curve. Adding a little bit of cheap debt is good. It lowers your WACC. But if you add too much, the company gets risky, and the cost of both debt and equity goes up, so WACC rises again. You're looking for that sweet spot at the bottom of the U.
And what did Modigliani and Miller say?
Well, their first theory, with no tax, was radical. They said it doesn't matter. WACC is a flat line. The benefit of cheap debt is perfectly canceled out by your shareholders getting nervous and demanding a higher return.
But we don't live in a world with no tax.
We do not. And their second theory, with tax, acknowledged that. Because interest is tax deductible, debt becomes incredibly attractive. So that theory suggests your WACC just keeps falling the more debt you add. You should be like 100% debt financed.
Which is obviously not realistic.
No, because of bankruptcy risk and all sorts of other real-world problems. But here was the specific error the examiner flagged. Students kept listing pecking order theory as a way to optimize your capital structure.
And it's not.
It is not. Pecking order isn't about finding the mathematically perfect WACC. It's a theory about manager behavior. It just says that managers prefer to use internal funds first, then debt, and then, only as a last resort, issue new equity. It explains what they do, not what they necessarily should do to hit a target.
That's a really subtle but important difference. It's about preference, not optimization.
Exactly. And showing you understand that difference is what gets you the top marks.
So looking back on all this, from the 912 and the FRA to versus buy to market values and WACC, it's a lot of small details.
It is. If I had to boil it down, I'd say, 1, slow down and actually read the question. 2, watch your time apportionment on anything to do with interest.
3, market values are king for WACC. And 4, don't just memorize formulas. Understand the logic, like that indifference point just being a simple division problem.
If you know why you're doing something, the how is much, much easier.
You know, before we wrap up, I want to circle back to that noise trading idea. The examiner called it irrational, herd behavior.
Right, the opposite of an efficient market.
And it just makes me think, all these models we study, WACC, dividend growth, they're all built on this assumption of a rational investor making logical choices based on fundamentals. But we live in an age of meme stocks and viral trends where things move because of noise.
That's a very fair point. The market is definitely getting noisier.
So if a huge part of the market is driven by this irrational noise, does that mean our rational models are breaking? Or at least becoming less useful? Are we just ignoring the biggest variable, which is raw human emotion?
That is the multi-billion-dollar question, isn't it? The models all assume a rational economic actor. If that actor is an endangered species, then maybe the models are just theoretical. But for the purposes of the exam, you have to stick to the model. You can solve the existential crisis of modern finance after you get the qualification.
That is very good advice. Stick to the syllabus for now. Thanks so much for breaking all this down.
My pleasure.
And for everyone listening, take these insights from the examiner, learn from the mistakes, and go nail that next challenge. We'll catch you on the next deep dive.